Warm greetings to all the learners of Dr. B.R. Ambedkar Open University. In today's session related to the BCom program, we shall be discussing about the topic stock exchange, which belongs to your course business organization. The concept of stock exchanges is not new to the world. We've been seeing many investment options where people search for where to keep their money so that the money grows, because money by itself, if kept idle, does not multiply. It needs to be invested in right options, right avenues, so that there is appreciation in the money which happens. And stock market is one such place where you have money being invested, where there is a lot of appreciation which happens in the money which is getting invested. Let us see what is the stock exchange, what happens in the stock exchange, and why is it important for the economy of a country. If you talk about stock exchanges and the history related to stock exchange, capital markets, the concept is not new to India, and capital market is actually divided into two markets, which is called as primary market and secondary market. Secondary market basically is nothing but the stock market, while the primary market is called as the new issues market. If you look at how this capital market evolved across the world, we also talk about the capital market dating back in India right from British era, where we talk about East India Company in India and the shares of the East India Company being traded in the 18th century. Then for any country to grow and the capital to be mobilized for the country or capital to be formed, we need the help of these capital markets or the stock exchanges which are there, because as the corporate sector grows, we have the growth of the capital market also. In India, if you see, the first stock exchange was established in Bombay in the year 1857, followed by the second stock exchange which was established in Ahmedabad in the year 1894. So, this is a brief history of what stock exchanges, how the development has happened in India, where we talk about how companies or the corporate bodies raise money from the public, and this particular money is invested and reinvested again through the concept of stock exchanges which are there. If you see in a capital market, we have two divisions. We have something called as a primary market and then we have a secondary market. Primary market is also known as new issues market, and the secondary market is known as your stock exchange. In the new issues market, industries, corporate bodies and companies, they raise money by issuing different types of securities. Money is capital which a company has got. That particular capital is raised through the new issues market by a company when they issue various types of securities. These securities are directly bought by the investors. Such investors can either be financial institutions or individuals, and all these investors are giving money to the company in the form of a capital, and that particular capital is raised in a primary market, which is also called as the new issue market. So, therefore, primary market we can say is an arrangement whereby you have companies which are there in the country, they try to raise capital. See, whenever we form a company, the company requires money to start its operations. So, when the company requires this money, it is called as capital. This capital can be raised by the company through issue of shares or through issue of debentures. When we talk issue of shares, we are talking about investors buying shares of a company whereby they become the shareholders in a company. So, when a company is raising money through issue of shares in a market, that particular market is called as a new issues market, or it is also called as a primary market, where other companies, other institutions or other individuals buy the shares of some company which is trying to raise money through the issue of shares in this particular market, which is called as the new issues market. New issues market, which is also called primary market, it basically performs three main functions. The first function is origination. In origination, what happens is, even before the shares are being issued, even before the shares are floated in the market or it is issued for raising money, there has to be a careful technical, economic and financial viability analysis in order to ensure that the project and that the company which is raising money is actually a genuine and authentic, and it is a viable company which is there. So therefore, before the shares are issued in the market, you have a thorough ground checking related to the soundness of that particular company, related to the technical, economic and financial viability of the company, so that when the money is raised, the company is able to form capital, and later on it is the traders are able to trade the securities in the market, the investors. So that is the origination. Then you have underwriting. Say for example, there is a company X which wants to raise 100 crores in the market. Now that is their target which they want to raise the money. But what if they are able to raise the money only up to the extent of 50 crores from the market, whereby the remaining another 50 crores is not yet reached. That means the people, the investors have not yet purchased the shares related to the 50 crore. So there you have an arrangement whereby individuals or institutions will come forward to see to it that this particular issue is actually being met through their investment. So when public as such do not subscribe to the shares of a company, or do not buy the shares of a company, or do not give money in the form of capital to the company, then you have an agreement whereby underwriters can be institutions, banks, or it can be individuals who are promising to give a specified number of shares or debentures or capital to the company in case the issue which the company has made to the public and the public are not subscribing to those shares, then these underwriters actually give up that particular subscription. So in case a company, say for example, is raising 10 crores, and if you have got only 7 crores through public, so people have invested only up to 7 crores, remaining 3 crores can actually be contributed by underwriters who can be financial institutions, banks or any other individuals who are promising to give up that particular amount which is not raised by the public. This arrangement is called as arrangement of underwriting, which is the second function in a new issues market. The third function is distribution, whereby whoever are the ultimate investors, they actually buy the securities in the market. So therefore, in a new issue market, when a company is raising money from the public, actually the new issues market does a checking related to economic, financial viability of the project, and if the money is not raised through the public, they will also do underwriting through the help of underwriters, which can be banks, financial institutions or individuals, and ultimately there is distribution, which is nothing but sale of securities in the new issues market which is there. These are the three functions, core functions of a new issue market: origination, underwriting and distribution. Now coming to the various ways by which these shares are being issued. Now when we are saying that a company is raising money in the capital market, in the new issues market, how can they raise money? There are 6 ways of raising money in the market. So whenever a company is floating shares in the market, they can go for something called as a public issue. For example, I am a new company and I want to raise money through the capital market. Then what I will do is I will issue a fixed number of shares to the public, and those public will start buying the shares from the market at a stated price. So each share can be priced at say 100 rupees or 1000 rupees, and if I am buying some 10 shares or 100 shares, then those many number of shares get multiplied by the stated price, and this process is called as a public issue, which means that the company is raising capital through leaving the option open to the general public, so that the general public can subscribe to the shares in the company and they can become contributors of the capital, and subsequently when they buy shares they become shareholders, which is nothing but owners of the company. This is called as initial public offering, where a company goes for issuing shares to the public for the first time. So we call it as an IPO. Recently in Indian corporate sector, if you see, a company by name Zomato has issued IPO. Similarly, we can also have a concept called FPO, which is called further public issue. When a company raises money for the first time by issuing shares, it is called as IPO. If the company is raising money again through the issue of shares, that is subsequently after your initial public offer, maybe second time or third time, that is called as a further public issue. So, first time maybe in the year 2000 I issued shares, again in the year 2010 if I am issuing, in the year 2018 if I am issuing, the issues which have happened in 2010, 2018, they will be called as further public issues which are there. ONGC is a company which has gone in for a further public issue in the recent times. So, you have public issue, which is one method of raising money in the capital market. Second method is offer for sale. In offer for sale, what happens is, whichever is the issuing company, for example, company A is raising money, then that company will become an issuing company. That particular company, with the help of brokers or issue houses, they raise money. So, brokers or issue houses will buy the shares of the company, and later on the issue house or the broker will sell these shares to the investor. So, here offer for sale is happening not to the investors, but it is happening to the issue houses or to the brokers, and they will in turn sell the securities to the investor. In recent times, Coal India Limited has offered for sale and raised the money through the primary market. Then you can also raise money through something called as private placement. In private placement, what happens is, limited number of shares will be offered only to selected people who are there, maybe selected investors or selected financial institutions or venture capitalists who are sophisticated, who are wealthy customers or who are priority customers, investors who are there. To these people the securities will be sold. So, high net worth individuals who are there in the market or financial institutions or banks, they buy the shares of the company. Such a arrangement where you are selling the securities to a limited number of sophisticated individuals, banks or financial institutions, this is called as private placement. In India, Tata Capital has raised money through private placement. Another option of raising money in the primary market is called as a rights issue. In rights issue, what happens is, whoever are the existing shareholders, for example, if a company A has offered shares where 30 people have bought shares, so those 30 people will be the existing shareholders. Now, if I am issuing shares again and if I offered these shares to these 30 people only, then this will be called as a rights issue. It means the existing shareholder has a right to buy the shares of a company. So, offer of shares to the existing shareholder is called as a rights issue. Reliance Industries in India has gone in for a rights issue in the recent time. Similarly, you can also have something called as a bonus issue, where whoever are the existing shareholders, without any payment, they will get shares of a company because company enjoys something called as free reserves. So, from the free reserves which are present in the company to the existing shareholders, you issue something called as a bonus. So, this is also a way of raising money in the capital market. In recent times, Kothari products have gone in for a bonus issue which is there. The last one of raising money in the primary market is called as ESOP. ESOP is nothing but an employee stock option plan. In employee stock option plan, what happens is, shares of a company are being made available to the employees of the company, not all the employees, but key personals in the company who enjoy higher positions such as directors, board members, managers, CFO or CMO. All these people who are key personals in a company, they will have a share or they buy the shares of a company. It is in the form of like rewarding for the better performances for all those individuals who are in the higher positions in the company. So, therefore, whenever you have a company which is raising money in the primary market, you have raising money in the form of a public issue where you are issuing shares to the general public to subscribe, or you can have offer for sale where you have brokers, the shares are being given to brokers who in turn will sell to the investors, or you can have offer which is being made to sophisticated high net worth individuals, financial institutions and banks, which is called private placement, or you can issue shares to existing shareholders, which is called rights issue, shares to the existing shareholders free, which is called bonus issue, or you can also issue shares to the high net worth individuals within the company who enjoy high positions in the organization, which is called ESOPs, employee stock option scheme. In recent time, many companies in India have gone in for all these types of issuing new shares which are there. This is to do with what is your primary market. Now, actually coming to what is a secondary market, which is nothing but a stock exchange. Stock exchange is a marketplace where all these shares are bought and sold. For the first time, whenever a company is issuing shares, it is done through a primary market, which is called new issue market. But later on, when the shares are getting traded, are frequently being bought and sold, such kind of an arrangement is being made in a marketplace which is called as a stock exchange. So, stock exchange is the backbone of any economy, any financial market, which will enable investment and economic growth, where all the individuals are free to trade in financial instruments. Financial instruments can be a share, can be a debenture, can be a bond. So, where they have a right of ownership and they can also sell away these securities to the other people who are trading in the stock exchange. So, this arrangement where trading of securities take place, you call it as a stock exchange or a stock market, which is also called as a secondary market. In India, if you see, there are a lot of stock exchanges which are there. One of the oldest stock exchange which is there in India is called as a Bombay Stock Exchange. This was established before independence in 1875. The headquarters are in Mumbai, and this was basically formed by private people by name Premchand Roychand, and currently it is owned by a group of shareholders which is there. This is a recognized stock exchange in India which is called BSE. Then we have NSE, which is National Stock Exchange, which was formed in the year 1992. This is also headquartered in Mumbai, and this is being founded by various global and domestic institutions, financial bodies, public and privately owned entities, and also individuals. Then you have stock exchanges. BSE and NSE are the major stock exchanges where equity, that is shares, are being traded. Apart from that, you also have stock exchanges which trade into something called as commodities. Commodities such as agricultural commodity, petroleum, metals like gold, silver, all these are also traded on the stock market. A stock market where all these trade takes place is called as a commodity market. So, NCDEX, which is National Commodity and Derivative Exchange, this was founded in India in the year 2003, and the headquarters are in Mumbai, where it was founded as a body by various other bodies like NSE, ICICI, CRISIL, NABARD, LIC, and many other public financial institutions came together in order to start the stock exchange, which is called National Commodities and Derivative Exchange, which was formed in the year 2003. Then you have Metropolitan Stock Exchange of India, which was found in the year 2008. The headquarters are again in Mumbai. Then you have Multi Commodity Exchange of India, which is called MCX, which was again formed in the year 2003. Then you have India International Exchange, India INX we call it, which is actually a subsidiary of BSE. This was found in the year 2017, and the headquarters are in Gujarat. So, these are the basic 6 popular stock exchanges in India which are there, where trading of equity and trading of all other commodities basically take place. Let us see all these stock exchanges one by one. First one, National Stock Exchange. National Stock Exchange is the Indian stock exchange which is based in Mumbai. It is one of the fastest growing stock exchanges in the world actually, because it occupies 7th place as the largest stock exchange in the world, and at the close of 2024 May, the total money which was raised through NSE was to the extent of $5 trillion. This was formed in the year 1992. Later on, after SEBI was formed, this also got recognition by SEBI. SEBI is actually Securities and Exchange Board of India, which is a regulatory body for all the stock market activities which are there. In India, NSE is the first stock exchange which is a fully computerized electronic trading stock exchange which is there. Now, for any stock exchange, if you see, there are certain parameters which will tell you how the stock exchange is performing. These are called as indices. So, the performance of National Stock Exchange NSE is measured by an index which is called as a Nifty. So, NSE includes indices such as Nifty, Next 50, Nifty 500, Nifty mid cap companies, Nifty small cap companies, Nifty mid small cap companies. So, like that, depending on whichever category the companies belong to, you have a separate index which actually helps you to measure the performance of those companies which are listed on the National Stock Exchange which is there. So, this is first stock exchange in India. Then you have Bombay Stock Exchange. Bombay Stock Exchange, as I said, is one of the oldest stock exchanges in India, which was established prior to independence in India. This is a privately owned company Later on, under the Securities Control Regulation Act in 1957, this was recognized, but BSE is not a state-owned stock exchange as such. BSE is a privately owned company. And the index which measures the performance of companies which are listed in the BSE is called as Sensex. And BSE is also one of the fast exchange in India, because it has a trading speed of 6 microseconds. That means any trade which has to take place, that is buying and selling of security, that basically takes place within 6 microseconds in Bombay Stock Exchange, which is there. National Stock Exchange is the 7th largest stock exchange in the world, whereas Bombay Stock Exchange is the 6th largest stock exchange in the world, and also it is one of the oldest stock exchange almost in Asia and in India. So you have Bombay Stock Exchange, the index which measures the performance is called as Sensex. Apart from Sensex, you also have other indices such as BSE 100, BSE 200, BSE 500, depending BSE Metal, BSE FMCG, BSE Pharma, BSE Auto, depending upon whichever sector the company belongs to. For example, if you are talking about BSE Pharma, you will have companies such as Reddy's Lab, Abbott, all these companies which are pharma companies whose shares are traded on the stock exchange, where the index which measures their performance is BSE Pharma. Likewise, you have BSE FMCG, BSE Metal, all these stock exchange indices are available to measure the performance of those companies which are listed on the Bombay Stock Exchange. Then you have Calcutta Stock Exchange, which is also one of the oldest stock exchanges in India. This stock exchange was basically formed under a neem tree in Calcutta in the year 1830. Since then, this particular stock exchange has been functioning. And as I said, it is one of the oldest stock exchanges in Southeast Asia, and in 1908, this was incorporated as a stock exchange with 150 members holding membership in the stock exchange. And Government of India gave recognition to Calcutta Stock Exchange under the Securities Control Regulation Act in the year 1980, and the stock exchange index, which measures the performance of all the companies which are listed on Calcutta Stock Exchange, is called as CSC 40. So, CS 40 is the number which represents the number of companies which are traded on the stock exchange. Then you have Metropolitan Stock Exchange, MSC. Basically, Metropolitan Stock Exchange is a digital, open, technological trading platform which is available for commodities, currency derivatives, capital markets, future transaction, option transaction. All these are all done on a Metropolitan Stock Exchange. This stock exchange basically was recognized by SEBI, and Ministry of Corporate Affairs, Government of India also recognized this stock exchange in the year 2012. And this is a digital open technology trading platform which is there. SEBI also started allowing this particular stock exchange to do SME trading also on their exchanges. Then you have National Commodity and Derivative Exchange, NCDEX, which is also one of the largest commodity exchanges in India. What happens is, in a stock exchange you have trading of equity which take place, whereas trading of commodities such as agricultural commodities or metals or energy resources, all these are all traded on another stock exchange which is called as a commodity exchange, and NCDEX is a commodity exchange which is available. And NCDEX was basically formed in order to offer products such as AgriDex, NCDEX, all these were traded. And here trading takes place related to agricultural products such as pulses, cereals like chana dal, barley, moong dal, oil seeds like mustard seeds, crude oil, palms, seed oils, oil seeds which are there, and also spices such as turmeric, coriander. All these are all commodities, and these commodities are actually being traded on a stock exchange which is called National Commodity and Derivative Stock Exchange, NCDEX in India. Then you have Multi-Commodity Exchange of India. Multi-Commodity Exchange, as the very name tells, multi-commodity. Not only does trade takes place related to agricultural commodity, but even non-agricultural commodities are also traded on the stock exchange. So, unlike NCDEX, where you have only agricultural commodities which are traded, here on MCX you have cotton, crude palm oil, rubber, cardamom, which are all agricultural products. Apart from that, even metals and energy resources such as aluminium, zinc, copper, or bullion like gold and silver, and even energy like natural gas and crude oil, all these commodities are also traded on the Multi-Commodity Exchange of India, which is MCX. And MCX is also listed both on BSE and NXE also. Now, all these are all various stock exchanges which are there in India: Bombay Stock Exchange, National Stock Exchange, Calcutta Stock Exchange, Multi-Commodity Stock Exchange, Metropolitan Stock Exchange, National Commodity Derivatives Exchange. All these are all various stock exchanges which are there in India. Stock exchange as such, because it is a place where trading of securities take place, it performs lot of functions for an economic development of a country. It is a contributor for, and it is a ready market which is available for trading of securities, and also it serves as a barometer so that the country can measure its economic performance depending upon how much money is mobilized, how much money is invested, how companies are raising money, how much money public holds, and where is the public investing money. All these measures can be known through the stock market as such. And also, whichever companies are having difficulty in raising money, they can actually come to stock exchange and list their shares and start raising money. There is also a facility of bank lending in the stock exchange in the form of underwriting. So, stock exchange is a place which serves as a barometer for economic development. Bank lending takes place. How economy is growing, how money is being mobilized, how capital is being formed, how various company securities are being evaluated, how the management of a company is being regulated. All these activities and functions are basically performed by a stock exchange as such. Therefore, it is very essential for economic development and financial growth of a company that the presence of a stock exchange necessitates that there is a smooth capital formation and capital mobilization in the country which happens. Because stock exchange is a place where trading takes place, let us see who all are the participants in the stock exchange. Basically, you have a participants in the form of something called as depository and depository participants. You have NSDL or CDSL, which is National Stock Depository Limited and Central Depository Limited. These are institutions which are actually holding all the securities, and whenever any member or investor wants to purchase, they basically purchase from these two bodies, which is NSDL or CDSL. So, as a company, for example, I am a company and I am raising money in the market. Then I give my securities to NSDL or CDSL. They hold the securities, and later when depository participants are wanting to trade, they open a demat account and then trading takes place. So, there is a depository participant, then there are trading members who open trading account on the stock exchange. There is also a clearing body which clears all the transactions on the trading members, and there are clearing houses which gives financial guarantees in case the transactions does not get effected or executed. Then there is a financial guarantee which is being provided by the clearing houses, and there is a bank which is basically linking the clearing member and the clearing houses. Now, as I said, whenever a company wants to give their shares for trading on a stock market, the process of trading on a stock market or a stock exchange is called as listing. So, listing is nothing but getting their name registered on the stock exchange. So, how companies will first get their name registered on the stock exchange? You have to follow various documents which are necessary. You have to submit details of a company, articles of association, memorandum of association, last 5 years financial reports of a company, details of what is the company capital structure, prospectus, all that has to be given by the company. So, only then the company's shares will be listed. After listing happens, then the trading will take place where an investor starts buying and selling these securities. So, therefore, listing will happen. Then there is also delisting and relisting which is there. In case any company does not follow the regulations given by the SEBI, then they will get delisted. It is called compulsory delisting, or they can be voluntary delisting also. where companies on their own exit from the stock market which is there. Then sometimes after some years company wants to come back and want to trade again. So that is called as relisting which is there. So listing, delisting and relisting is a process whereby companies get their names registered in the stock markets so that they can start trading their securities in the stock exchanges. So in today's session we have dealt about what is a stock exchange, which is a primary indicator of economic development or economic activity in a country, where the corporate bodies and the companies and the industries which want to raise money through the public, they issue shares to the public, securities in the form of shares, debentures and bonds to the public, and all these securities are traded in a stock market, whereby this particular trade indicates how capital is raised, how capital is formed and how capital is mobilized in the entire economy, which adds to the progress of the economy. So in today's session we have focused on stock market, prior to which we have discussed what is a new issues market, which is also called primary market, because capital market basically is divided into primary market and secondary market. Primary market is the new issue market where a company is issuing shares for the first time, and secondary market is a stock exchange where trading of securities take place. So this is about capital market comprising of primary market and secondary market, new issues and stock exchanges. Thank you.